Welcome to the School Nutrition Program's training on resource management. Today's training will give an overview of regulatory resource management requirements in the National School Lunch Program. This training is most appropriate for school business officials responsible for the financial management of the school meals program, as well as school nutrition professionals, such as food service directors. We'll start today's training with a basic overview of resource management in the NSLP, including the area of operation by resource management requirements. Resource management refers to the financial resources of an organization and how they relate to specific program requirements. For the school nutrition program, specific program requirements are outlined in the Code of Federal Regulations in the areas listed above relating to the National School Lunch Program, the Special Milk Program, the School Breakfast Program, and the Federal Uniform Grant Guidance, which applies more broadly than to just the school nutrition programs. As the administering agency for the federally funded child nutrition programs, RIDE is required to assess each SFA's compliance with these requirements through our monitoring and oversight activities. In some cases, this occurs through an administrative review and/or procurement review process, which generally occurs on a 5-year cycle. In other cases, RIDE monitors compliance through the routine collection of documentation, such as through our net cash resource and paid lunch equity collection processes. Regardless of the oversight mechanism in place, it is imperative that SFAs have the process and systems that result in ongoing compliance with the resource management requirements. As we're all aware, the financial pressures on school food authorities are numerous and significant. SFAs must provide nutritious, well-balanced meals in an effective and efficient manner to all students, adhering to very tight budgetary constraints. RIDE is required by regulation to evaluate the overall financial health of each SFA's nonprofit school food service as a part of our routine monitoring and oversight activities. The goal is to ensure effective, efficient, and consistent management of all program resources while maintaining a system that documents all revenues and expenses of the nonprofit school food service account. This process is not only about safeguarding federal funds, but more importantly about ensuring that students receive the maximum benefit on funding provided to support the school nutrition programs. For these reasons, resource management is not just a responsibility of district's administrators and finance staff. While business managers and other finance staff members certainly play a key role in the actual accounting for and management of school food nutrition funds, there are many more voices involved in the conversation about how the funds should be spent and what goals the program is trying to reach. Food service professionals, district administration, and school board members must determine how to best fit the goals and desires of the broader school community for the school nutrition programs into the SFA's budget, while also ensuring that all expenses are in line with regulatory restrictions. As we've discussed, when we use the term resource management, we're referring to the financial resources of an organization. In the school nutrition programs, there are many facets of financial management that SFAs are responsible for understanding and complying with, which include, but are not limited to, those listed on this slide. Effective resource management not only involves knowing and understanding federal requirements, but also writing local policies and procedures that ensure continued compliance with these federal requirements through the course of daily operations. Throughout the rest of this training, we will look at each of these topics in more detail. As the previous slide shows, there are many components related to resource management. As I mentioned earlier, RIDE maintains oversight over certain components of resource management through ongoing routine processes, such as our annual collection of documentation related to net cash resources and paid lunch equity. While these processes help us ensure that SFAs are keeping up with resource management requirements, they do not represent in-depth oversight of these requirements. Instead, the administrative review process allows reviewers to dig deeper into an SFA's compliance with resource management requirements, including reviewing the processes and inputs related to our routine oversight activities more closely, as well as looking into other financial documentation. In an attempt to help states and SFAs best utilize time and resources, the admin review process employs a risk assessment tool, which allows reviewers to determine the areas most likely to result in noncompliance and which warrant a more comprehensive review. The risk assessment tool determines in which areas a reviewer is required to conduct a comprehensive review. But the risk indicator tool does not cover all resource management requirements, and RIDE may choose to conduct a comprehensive review in any or all areas, even if the tool does not require it. This is why your AR may vary from cycle to cycle, or when you compare notes with colleagues. Today's training is not centered around the administrative review process and questions, so we will not be focusing on the documentation required to demonstrate compliance in each of these areas, but rather the general program requirements that SFAs are responsible for. To start, we will discuss maintenance of the nonprofit school food service account. Federal regulation defines the nonprofit school food service account as the restricted account in which all of the revenue from all food service operations conducted by the SFA, principally for the benefit of school children, is retained and used only for the operation or improvement of the nonprofit school food service. In other words, this is the account that an SFA must maintain in support of the federal funded child nutrition programs, and funds within the account must only be used in support of those programs. Revenues deposited into the nonprofit school food service account will include all revenues accrued in relation to the child nutrition programs, whether federal or local sources. In order to maintain a nonprofit school food service account, SFAs must have a financial management system for the school food service fund that properly tracks, controls, and records all expenses and revenues. The system must allow the SFA to report accurate financial information and provide backup documentation as required by regulation. Documentation to prove the financial system meets this requirement may include the statement of revenues and expenses, a general ledger, or other similar documents. Maintaining a nonprofit school food service account does not necessarily mean maintaining a separate bank account, as long as the SFA's accounting system allows for all program revenues and expenses to be separately tracked. By entering into an agreement with RIDE to serve meals and receive reimbursement under one or more of the federally funded child nutrition programs, SFAs are agreeing to become stewards of federal funds and to use those funds only for intended purposes and to benefit the program. Maintenance of a nonprofit school food service account ensures that the school food service operates on a nonprofit basis and serves to safeguard the assets of the school food service. To maintain a nonprofit status, the SFA's annual review and expense statement does not have to show a financial loss or even break even, but it is imperative to ensure that program funds are being reinvested in the program and that program revenues are used only for authorized purposes such as food, equipment, and labor, and not used for capital purchases like land, buildings, or other unallowable expenses. To determine the nonprofit status, the sponsor must utilize and document an annual process to track expenses and revenues that identifies revenue excess or shortfall. As mentioned in the prior slides, all revenues associated with meals and snacks served as part of the federally funded child nutrition program must accrue to the nonprofit school food service account. This includes all federal reimbursement and state reimbursements, student payments, including for meals and a la carte items, as well as payments received for adult meals, catering, and vended meals. For any activity that is supported with resources from the federal child nutrition programs, any generated revenue must accrue to the nonprofit school food service account and must be accounted for using the appropriate uniform chart of account, or UCOA, codes and procedures. This slide displays common sources of revenue in the nonprofit school food service program and the appropriate UCOA codes for each. Codes 44601, 43401, and 43402 relate to federal and state reimbursements that an SFA receives based on meals served and claimed under the child nutrition programs. Codes 41611 and 41612 are appropriate for local payments received in support of full or reduced price student meals. While the UCOA codes displayed on the previous slide represent the most common program revenue codes that will apply to most SFAs, there are additional revenue codes that may be used depending on unique activities of each SFA. Many SFAs will use codes 41615 for adult meal sales and 41620 for non-program revenues, which would include any student a la carte sales. Some programs may also have need for the additional codes displayed, which are related to the special milk program, catering sales, vended meal sales, and sales from vending machines. If you have questions specifically to the uniform chart of account and how to appropriately code program revenue, please follow up directly with RIDE's UCOA team. Now that we've reviewed program revenue, let's move on to program expenses. Allowable program expenses are costs that are necessary, reasonable, and allocable to the NSLP. These costs must directly benefit the program and be compliant with federal regulations, which includes consistent treatment, proper procurement, and adequate documentation. Accurate tracking of allowable expenses help maintain program integrity and prevent issues during audits and administrative reviews. Unallowable program expenses do not meet criteria for reasonable, necessary, or allocable or otherwise prohibited by state or federal law, regulation, or guidance. Common unallowable costs include but are not limited to non-reimbursable free student meals, bad debt expense, capital expenditures not previously approved by RIDE, and expenses related to land, building, or general construction. We'll discuss these unallowable cost examples in more detail later in the presentation. It's important to remember that there may be instances in which an SFA incurs an expense in support of child nutrition programs that does not meet the criteria to be considered an allowable expense that can be charged to the program. When in doubt, contact your RIDE program specialist for additional guidance. As with revenue, program expenses must be accounted for using the appropriate uniform chart of accounts or UCOA codes and procedures. Many programs in Rhode Island operate under a contract with a food service management company, or with an agreement to have meals vended through a local caterer. The UCOA codes displayed on this slide are specific to those contracted food service management companies and vended meal relationships. Codes 55706 through 55709 apply to cost reimbursable food service management company contracts, and should be used to account for labor, food, direct operating expenses, and fees that are charged to an SFA by a food service management company under a cost reimbursable contract. Code 55710 is appropriate for use in fixed price food service management company contracts or vended meal contracts, in which an outside vendor is charged one established price per meal, which is inclusive of all costs associated with the production of that meal. Note, it is possible that an SFA will contract with a food service management company, but will have additional program expenses that fall outside of the food service management contract. The codes displayed on this slide pertain to food service management company or vended meals expenses only. Direct expenditures by the LEA for food, supplies, labor, and equipment are not passed through to LEA by a food service management company, would not be charged for these object codes. For SFAs that are operating an in-house food service program, or for those SFAs under contract with a food service management company or meal vendor, but who are incurring additional expenses outside of the contracted services, the UCOA codes displayed on this slide would be appropriate in accounting for those expenses. Note, the object codes displayed on this slide are to be used specifically when accounting for expenses related to the school nutrition programs and represent common expense categories for in-house operated food service programs. SFAs may incur allowable program-related expenses in other categories such as payroll, which would be accounting for using the appropriate non-child nutrition program specific UCOA object code, but would be charged to the food service fund and function. All expenses charged to the program must be accounted for using the correct UCOA string and specifically the appropriate fund and function for food service. In an ideal situation, the school nutrition program will operate in a way that is self-sufficient and does not require the infusion of additional funding outside of those revenue streams already discussed. However, there are situations in which local contributions may be required to be transferred into the nonprofit school food service account to cover temporary cash flow shortages, support the purchase of large equipment items, to cover an operational deficit, etc. In these situations, local contributions may be transferred into the nonprofit school food service account with no expectations or conditions for repayment, or the SFA may choose to designate local contributions as a loan to program which requires repayment at a future date. The USDA does not allow a fund transfer into the nonprofit school food service account to be retroactively designated as a loan subject to repayment in order to recover repayment of local contributions. A bona fide loan agreement must be in place at the time that funds are made available to the program. In this situation, short-term or multi-year obligations are permissible, but the conditions for repayment must be documented and agreed to in advance. Note, interest payments are not allowable program expenditures. Now that we've reviewed general requirements related to program revenues and expenses, let's look more closely at the types of expenses that may be charged to the program. Allowable program expenses can be categorized as either direct or indirect costs, depending on the nature and characteristics of the expenses. SFAs must make careful and consistent considerations in determining whether to categorize a cost as direct or indirect. Direct costs are those expenses that are specifically attributable to the nonprofit school food service program, and which can be sustained through written documentation such as time cards, invoices, and receipts. Examples of common direct costs include wage and salaries of food service workers, costs of purchased foods, food service supplies, media and promotional materials relating to the food service, capital expenditures relating to food service, example, food service equipment purchases. Indirect costs are those expenses which are incurred for the benefit of multiple programs, including the school nutrition program, and which cannot be readily and specifically identified with a particular program or cost objective. Indirect costs typically support administrative overhead functions such as accounting, payroll, purchasing, facilities management, and utilities. Examples of common indirect costs include payroll services, human resources, workers' compensation, procurement, gas, electricity, sewer, water, trash, and the superintendent's office. Because indirect costs benefit multiple programs, functions, or cost objectives, SFAs must follow fair and consistent methodologies to identify and allocate allowable indirect costs to the nonprofit school food service account. The most common method of charging indirect costs is through the application of an approved indirect cost rate. Each school year, LEAs may submit an indirect cost rate proposal to RIDE to receive approval to charge indirect costs. This proposal is for the entire LEA and is not specific to the child nutrition programs. If approval is received by the RIDE, the LEA must follow applicable guidance when applying the approved indirect cost rate when applying it to the nonprofit school food service account. For SFAs, recovering indirect cost through the use of an indirect cost rate, this includes applying the approved rate to the modified total direct cost base and excluding distorting items such as food costs, capital expenditures, and the portion of each contractual expense that is above established thresholds. Regulation currently requires that subrecipients exclude anything over the first $25,000 of contractual expenses when calculating the modified direct cost base. The federal threshold will increase to $50,000 effective October 1st, 2024. However, for public LEAs, the indirect cost rates are updated annually through RIDE's UCOA team, and LEAs should look for additional guidance related to regulatory updates as part of the annual indirect cost rate process. In limited circumstances, some SFAs may be eligible to recover indirect costs through the application of a cost allocation plan as opposed to an indirect cost rate. A cost allocation plan is used to establish a methodology for assigning a portion of incurred indirect expenses to particular program or cost objectives. In order to recover indirect costs from the nonprofit school food service account by applying a cost allocation plan, the plan must be approved by RIDE's Child Nutrition Programs Office prior to use. Remember, as we've previously discussed, program revenues must be used to support of the program and should be managed in a way that maximizes program benefits for students. While indirect costs are an essential component of operating a school nutrition program, RIDE encourages SFAs to manage program budgets to the maximum extent possible, in a way that focuses on direct program expenses which directly benefit the students being served. As previously discussed, in or for an expense to be allowable under the nonprofit school food service program, The good or service must have been properly procured in accordance with local, state, and federal laws, regulations, and policies. It is the responsibility of each SFA to ensure that they are safeguarding taxpayer dollars by purchasing goods and services at the best prices. At a minimum, SFAs must conduct all procurement in a manner that promotes full and open competition, maintain written procurement procedures in line with federal standards, and develop and maintain a written code of conduct that governs the performance of employees engaged in the section award and/or administration of contracts. SFAs must maintain records that are sufficient to document the history of procurement in a way that demonstrates full compliance with all local, state, and federal requirements. Payments made to vendors that have not been properly procured are not considered to be allowable expenses for the nonprofit school food service account. Note: procurement standards apply to all goods and services purchased in whole or in part with the support of federal funds. This includes contracts and services that may benefit other areas of school in addition to food services. For example, if the LEA has procured a contract for communication services, including phone lines, which benefits the entire LEA, but is able to specifically identify the cost of phone lines that are solely related to food service operation, and chooses to charge the cost of those phone lines as a direct expense to the nonprofit school food service account, the LEA must have procured the entire service contract in a way that conforms to federal requirements and must maintain the appropriate documentation to support the procurement process in order for the portion of contract charged to the nonprofit school food service account to be considered an allowable expense. In addition to meeting the criteria outlined under the cost principles previously discussed and being procured following proper procedures, certain costs require additional approval in order to be considered allowable under the nonprofit school food service account. Equipment purchases and other capital expenditure requests for items with a per unit acquisition cost that equals or exceeds the lesser of the SFA's capitalization threshold or the federal threshold must be approved by RIDE in order to be considered allowable expenses under the program. As of the date of this training, the current federal capitalization threshold for equipment is $5,000. However, effective October 1st, 2024, the federal definition of equipment is being updated to a per unit acquisition cost of $10,000. RIDE will release additional updates related to this regulatory change once more guidance becomes available from the USDA. However, it is important to note that if the SFA uses a capitalization threshold within its established policies and procedures that is lower than the federally established threshold, the most restrictive threshold must be used when determining the need for prior written approval. Recognizing the administrative burden created by requiring pre-approval for routine equipment purchases in the school nutrition programs, the USDA has granted state agencies with an approval equipment list permission to allow SFAs to purchase approved items, following competitive federal, state, or local procurement procedures as applicable without submitting a request to state agency for approval. RIDE has taken advantage of this flexibility and has established a policy titled Equipment Purchases in National School Lunch Program, which can be found on the RIDE website and which outlines the specific situations and common equipment purchases that do not require specific approval from RIDE in order to be considered allowable program costs. For any equipment purchases that fall outside of the established policy, SFAs must submit a capital expenditure request in CMP Connect, notify RIDE of submission, and receive approval from RIDE for the requested equipment prior to properly procuring and purchasing the equipment with program funds. In addition to the requirements that we've already discussed, all equipment acquired in whole or in part under a federal award must be managed in a way that meets all requirements as outlined in 2 CFR 200.313D. This applies to all equipment purchased in whole or in part with funds from the nonprofit school food service, including equipment that was purchased by a food service management company on behalf of an SFA as part of an approved food service management company agreement. Asset management standards include the following requirements: maintenance of property records, which includes a description of the property, a serial or ID number, source funding, including the federal award identification number, title holder acquisition cost, allocation information, location, use and condition, and any ultimate disposal disposition data. Physical inventory to be taken and reconciled with property records at least once every 2 years. Adequate safeguards to prevent loss, damage, or theft of property, and procedures to investigate and report any loss, damage, or theft. Adequate procedures related to the maintenance of equipment to ensure that it remains in good condition, and procedures related to the disposition of equipment which ensures that the SFA received the highest possible return, and that any proceeds from equipment disposal for purchases made from the nonprofit account accrue back to the program. As mentioned, these standards apply whether the equipment was purchased by the SFA directly or by a food service management company on behalf of the SFA. Where an SFA retains ownership of equipment purchased, which is case in all cost reimbursable contracts, where the cost of equipment is billed back to the SFA through the food service management company invoicing process, the SFA is responsible asset management. Note, federal regulations related to asset management will be updated effective October 1st, 2024. The changes to this section of the Federal Register are minimal and include minor language updates. Additional guidance will be made available as necessary, but SFAs should refer to the Federal Register directly for the most current requirements related to asset management and equipment records. Throughout this section, we've discussed numerous requirements related to the maintenance of a nonprofit school food service account and how to appropriately account for revenue and charge allowable program expenses. The financial management system of every SFA must include written procedures for determining the allowability of costs in accordance with 2 CFR 200 subpart E and the terms and conditions of the federal award. The SFA must also adequately safeguard all assets to ensure that they are used solely for authorized purposes. As part of the administrative review process, RIDE will ask SFAs a number of questions that are intended to assess the strength of the SFA's internal controls over allowable costs and other program requirements. As part of this process, we will ask SFAs about written policies and procedures, segregation of duties, accountability, financial management procedures, safeguarding assets, and competency and training of responsible staff. SFAs will be asked both to describe their process and controls and provide documentation that supports the processes described. As As a best practice, it is recommended that the SFA maintains a list of common allowable and unallowable costs for the child nutrition programs, and that the food service director and business manager attend allowable cost trainings at least once every 3 years. Finally, it is highly recommended that the SFA develop written financial management policies and procedures outline purchasing and accounting processes, segregation of duties, fiscal responsibilities, etc. Written accounting policies and procedures are integral to a strong internal control environment. Now that we have an overview of the nonprofit school food service account and the various components of managing that account, we'll move on to look at some more specific resource management requirements, starting with net cash resource. While maintenance of a nonprofit school food service account does not require an SFA's food service program to operate at a deficit or break even, NSLP regulations do require that the net cash resource of the nonprofit school food service account not exceed 3 months average expenditures as of June 30th of each year. When we use the term net cash resource, we are referring to all monies that are available to or have accrued to the SFA's nonprofit food service account at any given time, less cash payables. In order to provide sufficient oversight of net cash requirements, RIDE collects the SNP financial report in our CMP Connect online application and claims management systems on an annual basis. Generally, RIDE will ask SFAs to complete an SNP financial report sometime in late fall to report the most recently closed financial period ending on June 30th. This slide on the screen shows the current SNP financial report in CMP Connect, which has 9 items that will help SFAs and RIDE determine any excess net cash balances that may exist. For the first item titled Opening Cash Balance, the SFA will list the opening fund balance per the balance sheet. Next, for item 2 titled Total Revenue, the SFA will enter all revenue earned for the reporting period. For item number 3 titled Total Expenditures, the SFA will enter allowable expenses accrued or incurred during the reporting period. Item number 4 is system calculated and will display the SFA's operating surplus or deficit, which is equal to revenue minus expenses. Item number 5 is also system calculated and will display the net cash resource available to the SFA, which are equal to the sum of the opening balance plus the operating surplus or deficit. Once you have determined the net cash resources available to the SFA, the remaining questions will guide you in determining whether or not the current balance is considered to be excess, based on the definition we reviewed at the start of this section. Item number 6 will ask the SFA to enter the total number of claim months for the reporting period. For many SFAs, this will be 10 months. Which would account for the full school year operating NSLP or SBP, but this number could be higher for schools operating a year-round calendar, or for SFAs operating a robust summer program. The number entered here will be used to establish average monthly expenditures, so if your SFA operates a summer program, but the program is small and not comparable to school year operations, you would still use 10 as the number of claim months to get a more accurate picture of average monthly expenditures. Item number 7 is automatically calculated by the system and will display the SFA's average monthly expenditures, which is equal to the total expenditures entered into item number 3 divided by the operating months entered into item number 6. Item number 8 is also system calculated and will display the SFA's 3-month average expenditure by multiplying the value displayed in item number 7 by 3. Lastly, the system will determine the SFA's excess net cash balance by subtracting 3 months average expenditures as displayed in number 8 from the ending balance calculated in item number 5. If the value displayed as excess balance for item number 9 is a negative number or is equal to 0, then the SFA is in compliance with net cash resource requirements and no further action is necessary. If the balance displayed for item number 9 is a positive number, then the SFA is carrying net cash resource balance and is considered to be excessive, and a spend down plan is required. As we've discussed throughout this presentation, funds in the nonprofit school food service account can only be used in support of the nonprofit school food service program. When an SFA is carrying a net cash balance that is considered to be excessive, as defined in regulation, a spend down plan is required to show how the SFA plans to reinvest program funds into the school food service program, with the ultimate goal of bringing the net cash resource available below the 3-month average expenditures for the SFA while making meaningful program improvements. When developing a spend down plan, SFAs must prioritize the following 3 items: lowering the price of paid lunches to the extent allowable, improving food quality, and making other improvements to the school meals operations. Note: paid lunch prices must continue to meet regulatory paid lunch equity standards, which we will discuss in more detail in the next section of this presentation. Lowering paid lunch prices may not be an option for some SFAs. If there are no opportunities for the SFA to engage in any of the 3 strategies mentioned, RIDE can lower the rates of reimbursement to the SFA to prevent further accumulation of an excessive net cash balance. SFAs must submit a spend down plan at any time that an excessive net cash balance is identified through the annual SNP financial report collection. Proposed spend down plans must address the USDA established goals discussed, must only include allowable expenses, and must fully address the excess balance. In other words, if an SFA was found to have an excess balance of $500,000 and submitted a spend down plan which addresses only $300,000 of the total $500,000 balance, that plan would not be considered sufficient to meet regulatory requirements. Remember, proposed spend down plans must address the full excess balance and do not need to demonstrate that all excess funds will be spent down within the next operating year. SFAs may propose a multi-year spend down plan as long as all other requirements of the plan are fulfilled. As I mentioned in the previous slide, the goal is for SFAs to not only reinvest the program, but to make meaningful investments that will improve or increase the benefits received by students. SFAs should work with food service staff and consider their own local goals for their food service program when developing a spend down plan, but may also consider the following ideas: investing in farm to school, promotional materials such as farm to school promotional kits available through the Rhode Island Farm to School Network, budgeting annual funding to be earmarked specifically for local purchasing in addition to existing operational food budget, making plans to comply with the state's food waste and styrofoam bans or any other federal, state, or local regulations or laws that may require facilities upgrades, training, partner engagements, etc. hiring a school meals advocate to support the collection of meal benefit applications, and or using the surplus balance to invest in a non-pricing program through the community eligibility provision when possible, or to reduce unpaid student meal debt as allowable under program guidance. Note, we will discuss meal debt later in this presentation. The use of an existing fund balance to support unpaid meal debt is limited to specific circumstances and is only allowable as provided for in the program guidance. SFAs with questions on allowability of using excess food service funds to support unpaid meal debt should contact RIDE. Now we'll move on to discuss paid lunch equity requirements in the National School Lunch Program, which you may sometimes hear us refer to as PLE. Note that in this section we will be reviewing general requirements related to paid lunch equity, but will not be going into detail on how to complete the PLE tool. For specific questions related to the PLE process or tool, reach out to your RIDE program specialist. Prior to the passage of the Healthy Hunger-Free Kids Act of 2010, there were no statutory or regulatory requirements for sponsors in establishing prices charged to students that do not qualify for free or reduced price meals. However, USDA's research showed that the revenue received by schools for paid meals is often too low to cover the costs of those meals, effectively shifting federal subsidies designed for the lowest income students to less needy students. For this reason, regulations were established that require SFAs to ensure that schools are charging an equitable price for meals to non-qualifying students, which ensures that reimbursements received for free or reduced meals are not subsidizing meals served to non-qualifying students. The target paid meal price for non-qualifying students is equal to the difference between the federal free reimbursement rate and the federal paid reimbursement rate. As you can see from this slide, going into school year 24 to 25, subtracting the federal paid reimbursement rate of 40 cents from the federal free reimbursement rate of $4.25 for school year 2023, you arrive at a paid meal price of $3.85. At the time that this regulation came into effect, USDA acknowledged that for many schools, raising prices from current levels to the established target price would be a significant jump and a hardship for many families. For this reason, schools are often offered options for meeting PLE targets, including a cap on the amount that an individual school can be required to raise lunch prices in any given year. We'll discuss these options further in our next slides. Each year, the USDA issues updated guidance related to PLE requirements, including a tool that SFAs should use when determining their compliance and with and requirements related paid lunch equity. Dependent on each year's specific PLE guidance, there are multiple possible outcomes when assessing an SFA's PLE compliance. First, we'll discuss the outcomes in which the PLE process results in no required change for the SFA. The first and most common scenario is that the SFA is exempt from PLE requirements and does not need to engage with the PLE tool for determining current weighted average lunch prices for targets. While this is the most common scenario currently, the ability to be granted exception from PLE requirements for SFAs that offer a pricing program is dependent on annual guidance. For the last several years, Congress has granted flexibility to PLE requirements for SFAs carrying a positive cash balance as of an established date. SFAs will need to confirm their eligibility for exemption on an annual basis and based on the most current PLE guidance. SFAs offering a non-pricing program, typically through CEP or Special Provision 2, are also exempt from paid lunch equity requirements, and this exemption is not dependent on annual guidance. The next possible scenario is that after using the PLE tool, an SFA will determine that their lunch prices are at or above their average weighted requirement. It's important to note that while the overall target equity price is based on federal reimbursement rates, each SFA individual pricing requirements will vary based on historical pricing data, and SFAs must use the PLE to determine their own weighted average price requirements. For SFAs that are required to engage in the PLE process but after completing the PLE tool, have determined that their meal price exceed their weighted average price requirement or the target equity price, no further action is necessary. Lastly, I mentioned earlier that in order to limit the burden on schools and families, the USDA does not require schools to raise meal prices more than 10 cents in any given school year. For any SFA that chooses to raise meal price more than the required 10 cents in a given year, or who transfer in non-federal funds to support paid lunch prices in an amount that is higher than required based on the PLE tool, those amounts above and beyond the minimum requirement can be carried forward into further years and limit the need for additional price increases or contributions of non-federal funds. For SFAs that are required to engage with a paid lunch equity tool and through the use of that tool determine that current meal prices are below the SFA's weighted average requirement price, additional action is required. SFAs with paid meal prices below the PLE requirement can support paid lunch equity by either raising prices, infusing non-federal funds into the nonprofit school food service account, or a combination of these two actions. There is no limitation to the amount that an SFA can choose to raise the price in order to comply with paid lunch equity requirements. However, regulation does not require an SFA to raise prices any more than 10 cents in a given year, regardless of how far current prices are from the target price. As an alternative to raising meal prices, SFAs can also choose to transfer non-federal funds into the nonprofit school food service account in order to comply with paid lunch equity requirements. SFAs electing this option will use the PLE tool to determine the amount of non-federal funds required in order to be in compliance. When transferring funds into the nonprofit school food service account in support of PLE, the journal entry supporting the transfer must specifically reference paid lunch equity. In some cases, an SFA may choose to take a combined approach in which paid lunch prices are raised and non-federal funds are transferred into the nonprofit school food service account in order to meet PLE requirements. SFAs selecting this option must use the PLE tool to determine the necessary amount of non-federal funds based on their planned price increases, and any transfer of non-federal funds into the nonprofit school food service account must be documented in support of PLE requirements. As a reminder, for SFAs using the services of a food service management company, the SFA must retain control over the food service program, including being the final decision point regarding price increases. Food service management companies may recommend price increases to the SFA, but the SFA must have ultimate decision-making authority related to paid meal prices, which should be documented through school committee meeting minutes or other means. Next, we'll briefly move on to discuss the requirements around unpaid meal debt. All SFAs operating National School Lunch and/or School Breakfast program must have a written policy to address situations where children participating at the reduced price or paid rate do not have money to cover the cost of a meal at the time of meal service. SFAs have discretion in developing the specifics of their policies, which USDA expects will vary based on local circumstances and resources available to the SFA. USDA also requires SFAs to ensure the policy is provided in writing to all families at the start of each school year, and to families with children transferring to the SFA during the school year. There are a variety of ways to meet this requirement, and USDA allows SFAs to choose the option that works best for them. USDA encourages SFAs to share the policy with families in a variety of ways to make sure everyone gets the message. SFAs are also required to provide the written meal charge policy in writing to all school or SFA level staff members responsible for policy enforcement. This includes food service professionals responsible for collecting payment for meals at the point of service, staff involved in notifying families of low or negative balances, and staff who enforce any other aspect of the meal charge policy. USDA also recommends social workers, nurses, the home liaison, and other school staff members assisting children in need are also informed of the policy. USDA encourages SFAs to balance the importance of staying in the black with the importance of making sure participating students have adequate nutrition during the school day. Denying children a meal could lead to poor performance due to hunger, whereas providing a regular reimbursable meal ensures children have a well-balanced nutrition they need to focus in class. USDA also discourages what some refer to as lunch shaming, or the singling out of children with unpaid meal charges. Although the USDA does not set specific standards on how SFAs handle unpaid meal charges with families, there are requirements related to how unpaid meal debt is handled within the nonprofit school food service account. Unpaid meal charges may be carried over at the end of the school year, beyond June 30th, as a delinquent debt, and collection efforts may continue into the new school year. This allows SFAs to work with families to establish longer repayment plans and to continue pursuing collection efforts when students change schools in the district or move outside of the district. While an SFA is making active attempts to collect on outstanding meal debt, this debt would be considered as a receivable to the program and would be accounted for accordingly. However, once debt has been deemed to be uncollectible and/or when the SFA has ceased collection activities, this debt must be written off as an operating loss, and cannot be absorbed by the nonprofit school food service account. In other words, only non-federal funding sources may be used to restore operating losses from bad debts related to uncollectible student meal debt. In recent years, the USDA has issued certain exemptions to the paid lunch equity process that we discussed in the previous section. In certain circumstances, these exemptions may allow eligible SFAs to reduce the price of paid lunches by absorbing current year unpaid meal debt into nonprofit school food service account prior to the unpaid balance becoming bad debt. The allowability and circumstances surrounding these flexibilities are determined on an annual basis in line with each year's paid lunch equity guidance, and SFAs hoping to reduce paid lunch prices and unpaid meal debt with their existing nonprofit school food service account balance should consult with RIDE first. The nonprofit school food service account cannot be used to cover bad debt expense or any costs related to bad debt, such as continued legal and/or collection costs. According to USDA Policy Memo SP 47/2016, once delinquent meal charges are converted to bad debt, records relating to these charges must be maintained in accordance with the record retention requirements outlined in regulation. SFA records related to unpaid meal debt must demonstrate both appropriate accounting procedures as it relates to allowable costs, and use non-federal funds when unpaid meal charges are converted to bad debt, as well as adherence to the timeframes and methods of collection for unpaid meal charges as outlined in the SFA's written unpaid meal debt policy. These records include, but are not limited to, evidence of efforts to collect unpaid meal charges in accordance with the SFA's local policy, evidence that collection efforts fell within the time frame and methods established by the SFA's local policy, financial documentation showing when the unpaid meal charge became an operating loss, and evidence that the funds written off as bad debt were restored to the nonprofit school food service account from non-federal sources. Finally, we'll close out today's training by reviewing the requirements related to non-program revenue and the nonprofit school food service account. NSLP regulations require that revenue from the sale of non-program food covers the cost of the food that is not subsidized by federal reimbursement provided to support program meals. Non-program foods include any non-reimbursable foods and beverages purchased using funds from the non-program school food service account. This could include an a la carte item, including milk, individual entrees sold outside of a reimbursable meal, and snack items available for purchase, second student meals, adult meals, food sold outside of school hours, catering, vending machines, and vended meals. For most SFAs, an a la carte food offered during meal service will account for the largest share of non-program foods. In some cases, SFAs may engage in sales of food items through vending machines and/or at times outside of school hours, where the food items for sale were purchased from funds other than nonprofit school food service account funds. These types of sales are not subject to non-program revenue requirements, as they were not supported with program resources. All revenue from the sale of non-program foods that were purchased with funds from the nonprofit school food service account must be deposited into the nonprofit school food service account. SFAs that sell non-program foods are required to determine if the percent of total revenue generated from non-program foods is equal to or greater than the percent of total food costs that are attributable to the SFA's purchase of non-program foods. For example, if the cost of non-program foods are 25% of the SFA's total food costs, then the amount of revenue generated from the sale of these non-program foods must be at least 25% of the total revenue in the school food service account. The USDA has developed a non-program food revenue tool which must be completed annually to assess compliance. To simplify, the assessment only food costs need to be considered when measuring compliance with non-program revenue requirements. However, the SFA must ensure an adequate reference period is used when conducting the assessment in line with USDA guidance. If the SFA serves only adult meals, extra milks, and/or catering and vended meals, the SFA does not need to complete the non-program food revenue tool. Additionally, sales from catering and/or vended meals may be excluded from the SFA's non-program revenue calculations. However, if the SFA chooses to exclude catering and vended meal transactions from the reference period selected to demonstrate compliance, both the cost of food and the associated revenue of these meals must be excluded, and the SFA must be able to provide proper documentation, such as purchase agreements, invoices, etc., and information demonstrating the recovery of the full cost. Details on this requirement, including detailed instructions on assessing compliance, can be found in USDA Memo SP 20-2016. Similar to other non-program food sales and revenue requirements, SFAs must also ensure that nonprofit school food service account revenues do not subsidize the cost of adult meals, as the benefits of the NSLP and SBP are intended for enrolled children only. Breakfasts and lunches served to teachers, administrators, custodians, and other adults must be priced so that the adult payment, in combination with any per-lunch revenues from other sources designated specifically for the support of adult meals, is sufficient to cover the overall cost of the lunch. The costs must include the value of any USDA entitlement and bonus donated foods used to prepare the meal. The USDA provides several options for demonstrating compliance with adult meal pricing. If cost data is readily available, the SFA should use the per meal costing data to calculate the cost of adult meals. When cost data is not available, the SFA may use the formulas described in FNS Instruction 782-5 to calculate the adult meal requirement. We'll review these calculations in more detail on the next slide. Note: adult meal pricing requirements apply only to meals served to non-program adults. Non-program adults are those adults who are not directly involved in the operation and administration of the school nutrition program. If these adults are served, they must pay full price for the meals, or the cost of the meals must be paid to the nonprofit school food service account from another source. In general, non-program adults would include administrators, teachers, lunch monitors, parents, visitors, custodians, and any individuals that are not employed by the school food service program. Meals served to adults who are directly involved in the operation and administration of the school nutrition programs may, at the discretion of the SFA, be furnished at no cost. Though these meals are not eligible for reimbursement, program adults eligible for free meals would generally include staff member employed by the school food service program. This slide shows the allowable calculations for determining appropriate adult meal pricing. As mentioned in the previous slide, if cost data is readily available, the SFA should use per meal costing data to calculate the cost of adult meals. In this method, actual cost information for each component included in the production of an adult meal is used to determine the minimum price that must be charged to fully recover costs. When cost data is not available, the SFA may use the formulas described in FNS Instruction 782-5 and shown on the right-hand side of this slide to calculate the adult meal price requirement. The preferred method is the free reimbursement calculation, SFAs should not use the pricing program calculation if the program is significantly behind on paid lunch equity requirements, or they know the calculation results in a price below cost. Non-pricing schools, such as those offering meals to students at no charge under CEP or Special Provision 2, must use the free reimbursement calculation unless actual cost data is available. When using free reimbursement calculation, the USDA Foods value must include bonus and entitlement. The last topic that we will cover in this section is non-reimbursable meals and other food items offered to students at no charge. In some cases, SFAs may choose to offer non-reimbursable food items to students at no charge. Most commonly, this would include allowing students to select food components that do not meet requirements for a reimbursable meal, like selecting an entree item only with no fruit or vegetable, or selecting only a fruit, vegetable, or milk and allowing these students to pass through the point of sale without charge. While this could be considered an allowable practice, as with other categories of non-program foods, these non-reimbursable items cannot be subsidized by the nonprofit school food service account. To document compliance with this requirement, SFAs must track all non-reimbursable meals and food items served to students at no charge, and the nonprofit school food service account must be repaid from non-federal sources. The only exception to this requirement is for leftover meals, which can be served to students at no charge, but must be tracked by the SFA. Leftover meals are not eligible for reimbursement, and the SFA must maintain documentation to support that leftover meals are minimal and reasonable, and that meals are being produced in a manner which supports the goal of one reimbursable meal per student per meal period. This concludes today's training on resource management requirements in the school nutrition programs. Contact your RIDE program specialist with any questions. Thank you.